Hey guys, it's Sunday evening here, April the 24th, and I wanted to make a quick video here on getting assigned a position in a defined risk trade. So I woke up a little late on Saturday morning yesterday, checked my email, saw that I had gotten an assignment in one of my accounts. That's not an abnormal event. I usually get assigned weekly on positions. In my large account or the AST account, we trade primarily credit strangles, and the intent of those actually is to get assigned at a short position or a long position. So I wasn't really surprised about the email until I looked at it and noticed that it was in our 0DTE trading room account. And I knew that there would be some consternation and some worry about some newer members who have not been in a position before where they've gotten assigned. And so I thought this would be a good thing to go over quickly here before trading does start up next Monday on our assigned position, and just how assignment works in general, primarily with how we are trading that here, which is defined risk trades, not necessarily undefined risk trades like a credit strangle that we do in the AST program. So I think it behooves us to maybe just start at the beginning. I know this is basic for a lot of people, but because of the level of consternation that some members have every time an assignment happens, I think it's merited to just kind of go over this once again. So obviously there's two types of options that we can trade. There are calls and there are puts, right? A call and a put. And it's interesting that with those two positions, you can of course do a couple of things. You can buy those options, or you can sell those options, right? Buy or sell. And when we buy something, that is done at a debit. So that is a cost to us when we do that trade. When we sell something, that is done at a credit, and that would be obviously income to us, okay? Excuse my poor handwriting. So let's start with the definitions, first of all, of buying or selling an option, whether it's a put or a call. When you buy an option, you pay money. It's a debit trade. It costs you money, and you receive a right, but not an obligation. So you have a right, but no obligation. No obligation. Okay? No obligation in the trade. That's a B in there. No obligation. When we sell an option, it is, of course, a credit trade, and we do get obligated. There is an obligation. There is an obligation that we take on when we sell options. So let's just talk about buying. First of all, buying an option. So let's say that we bought an option. We bought a call option here at $30 a share. And let's say that the stock goes up to $35 a share. Okay. So with the call option now, we have the right to call that stock away from someone. We have the right to call that stock away. So the stock's trading at 35. We have the right to call it away from them at 30. We would make the difference between those two prices minus the debit that we paid. Okay, so that's how you would make money buying a call. Now let's talk about maybe buying a put option. Let's say again that the stock that we are looking at is at 30 and it drops down to 25. It goes in the money. We have the right to put this stock to someone at our strike price of $30 a share. Well, it's only worth 25, but we could put it to them. We could force them to buy it from us at 30. And we, of course, would pocket the difference there between those two, minus, of course, the debit that we paid for the option that gave us that right. But the key thing to understand with options that we are purchasing or going long or that are debit trades is that we have rights. You know, we could force this stock to get called away from somebody. We could force this stock to be put to somebody. We have rights, but we don't have any obligation. We don't have to do that if we don't want to, okay? That's a little bit different than when we sell an option. When we sell an option, we are obligated. So at first, when you sell an option, whatever it is, credit spread or strangle or naked call, naked put, it's kind of exciting because you're like, man, I just pushed this button and money immediately appeared in my account. And it really did. That's real money. That's your money, and that's your money to keep, right? But it's not free money. It is not free money. That credit that you received, that income that you brought in on that trade by selling an option, that's not free. You have taken on an obligation of some kind. And the obligation, of course, that we have taken on if we sell a call at 30 or sell a put at 30, in the call case, the obligation is that we will be short. We're willing to go short these shares of whatever underlying it is that we're trading at $30 a share. And so if the stock were to say go to 35, right, we would be short the stock. We would be assigned short shares at $30 a share, but the stock is trading at 35. So obviously when you short stock, you want it to go down, not up. And so that would cost us $5 minus the income, minus the credit that we received on the trade. Now, likewise on the put side, let's say that the stock comes down here to 25. And we have sold a 30 strike price put. Well, that means that someone has the right to put the stock to us at 30. We would be long those shares at $30 a share. But of course, the stock is trading at 25. So we would have lost $5 once again, minus the income that we brought in on the trade. Now, the key thing here is that when you sell an option, whether it is a standalone option, a naked option, or a spread, which is what we do in our 4 DTE trades, our SPY and our Q trades, where we have a defined risk trade by not only selling a short leg, but buying a long leg to protect that. Regardless, you are under obligation, right? And that obligation exists for the full maturity length of that option. So whether it's a weekly option or a yearly option, whoever you sold that option to has the right to assign that position to you at any time. And so first of all, you might think, well, man, that's scary. I don't want to ever sell options because I don't want to be in a position that I could always get assigned. You're always going to be able to be assigned on those positions. But it doesn't happen very often because, well, think of it from the other side of the fence. Think of it from the standpoint of the person that bought that option from you. It's got to make sense, right? If they're going to assign you on the put side and the stock is at $30 a share or higher, well, it doesn't really make a whole lot of sense for them to do that, does it? They're not going to force you. They're not going to put stock to you that is worth $31 a share at your price of $30 a share. So number one, you can almost be guaranteed that anytime any of your short legs on an option transaction are out of the money, that you will not be assigned, simply because it doesn't make any financial sense for the person that would be assigning it to you to make sense. Now, sometimes even when you get slightly in the money, it doesn't make sense. Let's just make up some numbers here. Let's say that this put that we sold at a strike price of 30, let's say that we brought in 80 cents. Let's say that we got an 80-cent credit on selling that. Just because that is in the money now, let's say it's $29.95 that it's trading at, even though it's in the money, they still had to pay 80 cents for that right. And so it still wouldn't behoove them. They still wouldn't make money on that transaction. Now, by the time you get to actual expiration date and all options are worthless, now there is 5 cents of intrinsic value and they would get assigned. But it becomes a little bit more iffy there. Well, the point of all this is that in our credit strangle that we did on our SPY, let's go take a look at it here. Here we go. Here's our SPY trade. So we had the 442s by 440s on our SPY trade, and the 442s were the short leg. Well, some of us, not all of us, but some of us got assigned on this over the weekend. I was one of those that got assigned. So you see my 442 strike here is gone. That's gone. And I've been replaced, instead of those 12 contracts, with 1,200 shares. Well, the challenge with that, and the thing that freaks it, first of all, it is a complete non-factor. Getting assigned on this is a complete non-factor to our P&L on the trade. Absolute complete non-factor. That's not what freaks people out. I think maybe some people think they don't understand that trade and how it's going to work, and so that might give some consternation, but it doesn't affect our P&L. What it affects is this, which is your buying power. So if you look at the transaction here, we go to the history tab here. You can see on that assignment, I got assigned $530,000. Yeah, slightly more than what I have in this account to trade, and so it puts you into a negative buying power situation. And that's what freaks everybody out. So here's a couple of things to understand with, again, a defined risk trade. So let's take a look at the SPY trade. Let's look at how we are positioned now in the curve and understand a couple of things. So the first thing that is important to understand, this is one of the reasons why we do trade defined risk trades in this trading room, is that you'll notice that we do still have our 12 long puts, okay? And so while I am assigned these 1,200 shares that are long, I also have these 12 shares that are puts. Well, that's perfectly hedged. 12, they're in the money, so it's very close to a 1 delta here. So you can see how that's reflected here. It doesn't really matter what happens with the SPY trade on Monday. It could tank all the way down to 365. There's no additional risk in this trade. We've already maxed, by going through both legs, by going through the short and the long leg, we've already maxed out all of the risk in this trade. So that's key point number one to understand, is that by getting assigned, there is no additional risk in the trade. Now, as far as the buying power is concerned, we will obviously zero that out on Monday as we close this trade out or roll the trade or adjust the trade. But that will go away on Monday as we adjust it, and you'll get your buying power back. So those are the two key things to understand. One thing that may come into play, I don't imagine that it's going to happen, but one thing that is interesting about getting assigned is that we actually, while we don't have any more downside in the trade, we actually do have a tiny bit of upside. Now, you'd have to have a pretty big move here on those shares that you've been assigned to move this trade from a loss into a profit. But it does exist there, and it does in fact exist the potential that you could get a move. You could look at the orange line, which is the theoretical profit and loss prior to expiration on Monday's afternoon session close. We actually have the ability to maybe even lower our max loss on this trade a little bit, even if we didn't get back into the money. Don't, again, expect that that would happen, but that is the potential. So that's the key thing to understand on getting assigned on a defined risk trade. Number one, there's no additional risk in the trade. Number two, you freak out about the buying power issue. We'll fix that tomorrow when we close out the trade. Number three, while there is no additional risk in the trade, there is some potential for reward. There is some potential for upside. So just again, wanted to share the idea of getting assigned. I know it's always a little bit of a scary thing when it happens, but hopefully that helps you guys understand it a little bit. And then, of course, we will be working on this trade first thing tomorrow morning in the trading room.